Hello, and thank you for joining us this morning. I'm Simon Chong. I'm the Chief Business Officer of MYTHEO. It is a pleasure to introduce our MYTHEO Live webinar on how to hedge against rising inflation. Before we start, allow me to provide a brief introduction of MYTHEO. Being an award-winning digital investment manager approved by Securities Commission Malaysia, we leverage on technology to offer you personalized, convenient, and affordable way to build your wealth. Our proven proprietary algorithm help identify the best investment while keeping risk at bay. Similar to how THEO financially supported his brother, Vincent van Gogh, to achieve his dreams, MYTHEO aim to help you achieve your financial goals and enable you to enjoy your moments in life. Okay. Just a quick rundown of our 1-hour session today. It will be in Q&A format with live polls in between. Meanwhile, if you have any question that you would like to ask the speaker, you can interact with us via the Q&A button on the top of your screen. We know that life is getting more expensive. All around the world, people are watching as prices get pumped up by forces beyond their control. In this webinar, Higher Inflation, Where to Put Your Money, we will be discussing the impact of rising inflation on various asset classes and how investment, particularly in an inflation hedge portfolio, can serve as an added portfolio diversifier to insulate and benefit against rising inflation. Today, I'm joined by my distinguished MYTHEO colleague, Stuart Box, who is the Chief Investment Officer of MYTHEO, where he is responsible for the development of all investment algorithms, portfolio management, and trading at MYTHEO. Besides that, Matthew is also the Chief Operating Officer of THEO Japan, where he is responsible for all investment platform-related teams, including portfolio management, trading, and operation. Welcome to the webinar, Matthew.
Thanks a lot, Simon. I'm very happy to be here. Thank you.
Good to see you. Okay. Inflation has been a hot topic since late last year. Malaysia has entered into positive inflation territory since February last year, with the latest annual inflation at 3.2% in December 2021. Higher consumer spending and more expensive food prices in the recent Chinese New Year festival certainly doesn't do inflation any good. In fact, inflation is not just a local, but it's also a global concern, with US and Europe struggling with the highest inflation in a decade. Before we dwell deeper into this, a question to the audience. How concerned are you about inflation over the next 6 to 12 months? Okay, so please let us know. Okay, so if you can see the result from the screen, okay, everyone basically is very concerned or somewhat concerned, right, with the inflation over the next 6 to 12 months. And I'm sure in particularly, inflation has also caused our cost of living increase and also could negatively impact our investment portfolio. So question to Matthew. Prices continue to rise all over the world. What has been the major causes of inflation? And is it a demand-led or supply-led?
Okay, thank you, Simon. Yeah, this is a very good question. And as you said, investors around the world are worried about inflation. Certainly over the last 12 months, it's ticked up in various different countries. And today I'll try and explain a little bit about the background to that inflation and what's been driving it and what might happen in the future. I think we have to start with this in the US. This is where the current round of inflation started, and it's probably where people have the most concern. This graph here is from the US Federal Reserve and shows a long history of US inflation. going way back to the 1950s. And you can see here on the far right-hand side, it's this part here that's caused the concern. Since the end of 2020, inflation has jumped up in the US. The most recent was 7.5%. And as you can see, that's the highest level of inflation in the US since the 1980s. So for the last 40 years or so. So it's natural people are concerned about it. We need to dig a little deeper into that inflation number to find out where it came from and what's been driving it. This data is also from the Federal Reserve in the US, and they provide a very good breakdown of the different components of inflation. So obviously inflation is an average of price rises across a whole number of different products. And this shows partly a breakdown of the different products here. And so this is the all items element. This is the 7.5%. Food has been up over 7%. But this is the one that's really been the cause for concern in the US, energy prices. And so this is oil, natural gas prices. And in the US over the last 12 months, they've risen by 27% in the US. And that's been the biggest driver of this spike in inflation. Other things have been going up in price, but 5-6%. But it's really been energy that's been the real cause for concern. Yep. And so to answer your question about whether it's demand or supply led, we have to look at the market for energy. And that's what's shown on this graph here. And so there's a lot of information on here. This top line up here, this dark blue line, shows the oil price over the last year or so. So you can see it falling down at the start of the pandemic and then gradually recovering over here. And then these two lines show the demand and supply of oil over the same period. This line here, this kind of medium blue line, shows the demand for oil. And you can see this falling very sharply in March, April 2020 at the start of the pandemic. But then you can see it's gradually recovered. And as at the end of last year, it's back above its level before the pandemic. So the demand for oil, driven by kind of the recovery, the global economic recovery, the demand for oil is now higher than it was before the start of the pandemic. This pale blue line shows the supply of oil. And you can see here, this also fell at the start of the pandemic, various supply issues, supply chain issues, things like that. And the supply of oil has also recovered, but you see it hasn't recovered as strongly as demand has. And so the supply of oil, the global supply of oil, if you look on here, is at 98.3. It's still below the level it was at the start of the pandemic. Yep. And so this has been the driver of the oil price surge. A mismatch between a strong recovery in demand and a slower recovery in supply. And then on top of that, obviously, geopolitical concerns to do with Ukraine and things like that. But underlying it is this demand and supply gap. And that's what's driven the spike in oil prices globally. Sure.
So it's a combination of strong demand and supply constraint as well as rising energy prices. Yeah. So what has been done to reduce inflation?
Sure. The central banks around the world, they have their own inflation targets, particularly in the US. The Federal Reserve targets 2% inflation in the long run. They've really done two things as a response to this spike in inflation. The first thing is to signal increases in interest rates in the US. So they haven't raised interest rates yet, but this graph on the left-hand side here is from the minutes of the Federal Reserve meeting. And they provide a prediction about interest rates in the future. And these dots here are the predictions of the individual members of the Federal Reserve Board. And so you can see this year, Most of the members expect a slight increase in interest rates, another increase in 2023, and another in 2024, up to a level of about 2.5% in terms of long-term interest rates. So the Federal Reserve is signaling that they do plan to raise interest rates in the US, certainly starting some point this year. The right-hand side here shows how the market is expecting interest rate rises. This data here is from a credit agency called Fitch in the US. And this dark blue line here shows their prediction for US interest rates. And so they're predicting 5 or 6 small interest rate rises starting from around the middle of this year on through to the end of next year. So one thing that the central banks have done has started to signal interest rate rises. The other thing that they've done is try to manage expectations, because there's an element of inflation where it's a self-fulfilling prophecy. If you expect prices to rise, then you'll demand higher wages, you'll demand higher prices for your goods, and so you'll tend to drive inflation by your own expectations. And so this graph here is also from the Federal Reserve minutes, and it shows their expectations of US inflation over the next few years. And as you can see, they're expecting inflation to fall to around 2.5% this year, and then down to around 2% for 2023, 2024. And so this is the Federal Reserve trying to manage the expectations of individuals in the US.
So with the central bank signaling a high interest rate ahead, as well as trying to manage inflation expectation, right? I mean, all this potential measure could be in place. What is our short and also long-term inflation expectations?
Yeah, sure. So a good place to start with this is the International Monetary Fund. And so they provide economic forecasts for most of the major economies in the world. And so this data is from the IMF. And it shows their expectations for inflation rates for the world, global inflation, the United States, and for the Euro area. So if we just focus on the US, certainly the IMF don't expect inflation to rise from here. Equally, they don't expect it to go back to zero. They're expecting inflation in 2022 to be about 3.5% in the US. So that's higher than what the Fed was saying. The Fed is saying 2.5%. The IMF is saying about 3.5%. So this is useful, but these are the predictions of a bunch of economists. As I said earlier, it's very important to think about like the expectations of individuals. And then when you look at that, it's a little different. This data is also from the Fed, and it shows a survey of individuals in the US. So not economists, just normal individuals in the US, and they asked them what they think will be inflation over the next 12 months. And so you can see here, over here, individuals in the US, they're expecting inflation to be about 5% over the next 12 months. So higher than the Federal Reserve, and indeed higher than the IMF themselves.
Sure.
So it's not just expectations, but also, how worried people are about inflation.
Yep.
This also is from Google search. It shows like how frequently individuals have been searching for the word inflation.
Yep.
And you can see here, certainly over the last 6 months or so, there's been a spike in the number of people searching for inflation. Certainly compared to a year ago, searches for inflation are running at about twice the level. So it's clear that individuals in the US, at least, are expecting inflation, and they're certainly worried about it.
Yep. So yeah, I totally agree with that. Definitely, for us as an individual, we felt the brunt of the rising inflation and rising prices, and more so in Malaysia, right? Our inflation rate has been at its highest last year, in May at 4.4%. And if you were to look at in 2020, we were at negative inflation rate. But the latest inflation rate that we have at December 2021 was at 3.2%, although it has moderated right from the high of 4.4%. What do you think is our Malaysia inflation rate going forward?
Yeah, sure. Okay, that's good. Yeah. So maybe let's start with kind of what the IMF predicts for Malaysia. So this is from the same database as we looked at earlier. This is the International Monetary Fund's forecast for inflation in Malaysia for this year, and they're expecting 2% for Malaysia. So falling back slightly from last year, but equally not going back to zero, at least in the short term. So they're expecting about 2% this year and for the next few years in Malaysia. As you mentioned, the recent inflation numbers in Malaysia have been about 3.2%. And similar to the US, it's important to look inside those inflation numbers and see what have been the drivers for them. And so this data is from the Department of Statistics, and they provide a very good breakdown of the different components of inflation. And so here we can see the 3.2% at the end of last year. And then they provide the inflation rates for different types of products. And these purple blocks here show the 12-month inflation rate for different things. And there's a big variation. You can see, for some things, actually prices have been falling. So you can see here, clothing and footwear. Actually, over the last 12 months, prices have been falling very slightly. Similarly for communication, so things like mobile phone charges, prices here have basically been flat for the last 12 months. But you can see here, transport, prices have risen by 9.5% over the last 12 months. And so this is also the same kind of thing as we saw in the US. This is energy prices hitting petrol prices, gas prices in Malaysia as well as in the US. And so this has been a big driver of the increase in inflation in Malaysia. The other thing to factor in for Malaysia, of course, is the currency. And so over the last 12 months, the ringgit's depreciated by about 4% relative to the US dollar. And so that's for any product that's imported from outside, that's also been a driver of inflation in that area as well. The Department of Statistics also provide a very nice breakdown down here, where they look at what they call core inflation. So this is the inflation rate when you strip out the effect of changes in food prices, energy prices, government-controlled prices, things like that. And so according to this, inflation over the last 12 months for Malaysia has been 1.1%, so not so bad. But that's a breakdown of kind of what's behind some of the inflation in Malaysia. But having said that, even inflation of 1-2% over the long run can be very painful. This also is from the Department of Statistics, and this shows the effect of inflation over the last 10 years in Malaysia. Over the last 10 years in Malaysia, inflation has averaged about 2%. And this is showing what's happened to your purchasing power over that year. And so this total, where it says here, what this is showing is that 100 ringgits 10 years ago, nowadays, after 10 years of inflation, that 100 ringgits is worth about 83 ringgits now. And so the purchasing power of your money over the last 10 years has fallen from 100 to 83. Sure. Obviously, the amount by which the purchasing power has fallen depends product by product. And each individual will have a different inflation experience depending on the kind of products that you buy. But on average, even 2% inflation has been very painful for people's purchasing power over the last 10 years.
Sure. So, well, we do expect inflation, or we hope inflation can actually fall, but at 2%, definitely, this is higher than the savings rate that we are having. So just a reminder to the audience, you can ask question by sending us your question from the Q&A button on the top of your screen. And before we proceed, I have another question that I wanted to ask our audience here. Do you currently have any investment in stocks, bond, ETF, or cryptocurrencies? Okay, so I guess everyone can see the result. Well, we have most of us here, we are experienced or seasoned investor, it looks like. Okay, so question to you, Matthew. With inflation rate currently still hovering, I think above 3%, and this is definitely still higher than our fixed deposit rate, right? What should we do with our money in the bank?
Okay, that's a very good question. Yes. This graph here shows the longer-term interest rates in Malaysia, and as you say, current interest rate is way below 2%, certainly below the level of inflation. And so, leaving your money in the bank means that over time it's losing real value. It's losing purchasing power at the moment. But having said that, that's not unique to Malaysia. It's the same for many countries. In the US right now, interest rates are below inflation. And so leaving your money in US dollars will also give you the same kind of problem. And so one solution for that is to use your money to invest, to buy assets that might go up in price. Obviously, there's no guarantee that the value of those assets will go up, especially in the short run. There's risk there. There's no guarantee that the price will go up. But if you choose a good, diversified portfolio of assets, there's a good chance in the long run of at least beating inflation, I think. Whereas if you leave your money in a bank, at the moment, you're guaranteed that you will lose relative to inflation.
Sure. So rising inflation does negatively impact the real value of our savings. And one solution is to invest, right? When you said to invest, right, can you share which asset classes and how are they performing under the current inflationary environment?
Yeah, sure. So this is a graph of the returns of various different assets, all in ringgit. So the ringgit returns for last year, 2021. And so you can see in the dark blue is the Malaysian inflation rate, the 3.2% that Simon mentioned. The red bar there is the performance of our MYTHEO inflation hedge portfolio. Maybe we'll come back to that a little later on. And then on the right-hand side is the performance of various different asset classes in 2021. And so you can see there's a large range of different performance. Some have done very, very well in this environment, and some have done quite poorly. The things that have done well, well, naturally oil has done very well. It was up 65, 66% in ringgit terms last year. But also things like US real estate had a very good year last year. Real estate globally did well last year, but especially US real estate up over 40% last year. Agriculture, you can see there, was up nearly 30%. So this is things like corn, soybeans, agricultural commodities did very well last year. And it was also a good year last year, just in general, for global equities, up over 20% last year. The assets that struggled last year, you can see two that are slightly negative. One is gold. And this might be a little surprising to some people. I think some people think of gold as a good hedge for inflation. And sometimes it is a good hedge for inflation, but really gold works as a hedge against crises, like global economic crises or political crises. And so certainly last year, gold was essentially a flat return. And then also on the far right, you can see US Treasuries with a slightly negative return. Like bonds in general last year struggled. A rising interest rate environment, a rising inflation environment tends to be negative for bonds. And so you can see they struggled last year as well.
So the combination, I think, of commodities, precious metal, real estate, as well as inflation-linked bond, right, has managed to sort of keep up, with the inflation that we are seeing, the rising inflation that we are seeing here, and therefore the portfolio has performed well. But if inflation start to moderate, right, and also normalize after this, will MYTHEO inflation hedge portfolio underperform?
Yes, so that's a very good question. I mean, maybe a little later we'll come to like the components of the MYTHEO portfolio, but I think the MYTHEO portfolio is designed to beat inflation, in particular to beat Malaysian inflation, and it holds many of the assets that are on this kind of graph. And so if we see in particular a sharp fall in inflation due, for example, to a collapse in demand, then parts of the inflation hedge portfolio would suffer. Things like the exposure to oil, real estate might suffer under that. But having said that, a lot of the components of the inflation hedge portfolio do generate returns themselves. Things like real estate holdings, they generate returns from rent and things like that. So even a relatively slow inflation environment, they're still likely to give you a positive return. But it's true, a return, if we think we're going back to, say, like zero inflation or something like that, then the inflation hedge portfolio would struggle in an environment.
Sure. Okay, maybe a question on the current economic growth moderating from the spread of the new COVID-19 variant. Is there a concern of stagflation, and will stagflation impact investment return? Okay,
sure. Yeah. So stagflation has been a word that some people have mentioned, and it's kind of a scary word for investors. Normally inflation is associated with periods of high economic growth, demand-led inflation. But you can get inflation with slow economic growth, as you mentioned, and stagflation refers to this environment of high inflation plus slow economic growth or stagnation. Thankfully, stagflation is rare. It doesn't occur very often. Probably the biggest single case was in the 1970s in the US. Where inflation went up to nearly 20%, interest rates went up to similar kind of levels, and there was a very sharp contraction in economic growth. Stagflation is normally cured by the central banks by a sharp recession, high unemployment, and then changes to try and boost supply. Stagflation would normally be negative for most major asset prices. Perhaps except gold, as I mentioned before, gold tends to do well in terms of crises. So gold would probably do well in an environment like that, and perhaps real estate. But overall, it's negative for bonds, it's negative for equities, it's negative for most assets. But the point is, most economists do not expect the US or any of the major economies to go into stagflation. Nobody's expecting that. Nobody is predicting that. The IMF, for example, their prediction for global economic growth this year is 4.9%, inflation at 3.8%. They're both very healthy numbers, very, very normal numbers. So nobody's expecting stagflation. But as you say, at the back of your mind, it's got to be a concern.
Yeah. Yeah. So So before we proceed, if I can ask another question to our audience. Which of the following do you use to manage your investment? Thank you for your participation. So, so if you look at the result here, well, most of us here, we basically manage our own investment, right? Okay. So back to the MYTHEO inflation hedge portfolio. How investor can successfully protect against inflation via this portfolio, and what can they expect from there?
So I can explain a little bit about how the inflation hedge portfolio works. Maybe put it a little bit of context. MYTHEO approaches investing perhaps slightly differently from some managers. We recognize that people invest for many different reasons. There's no one single reason for investing. And we generally think it in terms of three main groups of reasons. One, people who invest to grow their assets in the long run. Maybe take some risk, but over the long run, look to kind of grow the value of their assets. That's a perfectly reasonable reason to invest. Some people invest in order to generate income, and perhaps people who are retired, they want to generate income from their assets in order to provide for their living expenses. That's a perfectly valid reason to invest as well.
Yep.
And then a third reason might be to protect against inflation, which is what we're talking about today. But you know, the needs for these different kinds of investing vary by individuals, and MYTHEO will offer you a portfolio that's balanced across these three different types of portfolio to try and meet those needs. And we'll come a little later, perhaps, about how that might work. But if we focus in particular on the portfolio that's aimed to hedge against inflation, this is aiming to beat Malaysian inflation via investing in a diversified portfolio of assets. And these are mostly real assets. So things like commodities, agricultural commodities, industrial metals, oil, things like that. Precious metals, gold, silver, real estate, global real estate, and also bonds, which are linked to inflation. These are referred to as TIPS. These are bonds where the interest rate is linked to inflation. This is what the current portfolio looks like. So as of today, these are the holdings of the MYTHEO inflation hedge portfolio. And so each of these blocks here represents a different asset that we're invested in. And so you can see, you know, it invests in a good range of different assets. It's quite diversified. As of right now, the biggest elements in the portfolio are this kind of blue area here, which is US real estate. So this is about 30% of our portfolio is invested in US real estate, which covers, you know, retail real estate, commercial real estate as well. Another big part of the portfolio here is this, nearly 26% in TIPS. So these are inflation-linked bonds. But then we also have a material exposure here, 15% in gold as well, which is a useful hedge. But we also have exposure to various different metals, agriculture, oil, various different other parts of real estate as well. So it's a well-diversified portfolio of real assets. This is what the holdings look like through time. So we've just looked at a snapshot as of right now. But you can see the holdings tend to be quite stable through time. This is not a portfolio that turns over a lot. It's not looking to kind of jump in and jump out of different asset classes and try and time the market. What it normally does is keep a nice diversified portfolio through time. We've been running this portfolio live since 2019. So we have experience of running this thing with live money. And this is the realized return the portfolio since inception. And so you can see since we've launched it up until January this year, we've returned just under 21%. So from the point of view of beating Malaysian inflation, well, we've certainly managed to achieve that.
Yep. Great to see that the portfolio has managed to beat inflation and also deliver good return since the portfolio was launched in 2019. So how do I invest in MYTHEO inflation hedge portfolio then?
Sure. So maybe we can go through to here. As I mentioned, the inflation hedge portfolio is one element of MYTHEO. And it's very easy to set up an account with MYTHEO. You simply need to go to the MYTHEO website or download the app. Answer 5 very simple questions about your age, your investment objectives, things like that. And then MYTHEO will provide you with a recommended allocation across these 3 portfolios, this growth portfolio, an income portfolio, and this inflation hedge portfolio. And the allocation will vary according to each individual. Each individual's needs are different, but we will provide you with a recommended allocation across there. This is known as the omakase allocation. So you leave it up to MYTHEO. We will provide you with what we think is the best allocation for you. And then we'll maintain your portfolio, keep you on target with this allocation through time.
Sure.
This is what it looks like in terms of the questions and how your portfolio might look. These are the 5 questions over here. So as you can see, they're very simple. It only takes a minute or so to answer these questions. And then this is an example of the allocation that MYTHEO comes up with. So in this case, recommending 40% in growth, 34% in income, 26% in inflation hedge. And you can choose to go ahead with that allocation. And then, as I said, MYTHEO will automatically maintain your portfolio with these ratios. But you can also, if you would like to tailor that yourself, you can also change these allocations as well. You can go in and if you're more worried about inflation, you can choose to raise this 20%, 26% up or down, however you wish. Or if you want, you could choose to open like multiple accounts, multiple portfolios, and have one portfolio that's dedicated to inflation hedge and one that's a balanced portfolio as well. So this approach we found is very very flexible. It means we can provide portfolios that are tailored to each individual, but then it also allows the individual to customize the portfolio in whichever way they think is appropriate for them as well.
Thanks for that, MYTHEO. To our audience here, you guys are free to ask any question to MYTHEO by typing in your question from the Q&A button on your screen. So I've a few questions here from the audience, MYTHEO. What is the investment advice if you've foreseen the US share market will fall in the next 3 to 6 months?
That's a very, very good question. Yes. So we've seen an uptick in volatility in the US, certainly. And just to put it into context, the US stock market has been extremely strong over the last 3 years. Very strong and with very little volatility as well. So last year, the S&P was up over 20%, way more than its long-term average. And for the last 3 months, we've had some quite big swings in particular in the US equity market, driven by a number of factors. I think some have been company specific. In particular, US tech stocks had performed so well over the last 3-4 years that even though the financial results of some of those companies, things like Facebook, even though their financial results were pretty good, they were below people's expectations. And you saw Facebook in particular fall sharply on their earnings announcements and stuff like that. So part of the volatility has been due to people's expectations getting ahead of reality. And then partly of the volatility has been to do with people worried about inflation and worried perhaps about geopolitical risks as well. To get back to the question, what should I do about that? My advice is that to predict something like the US equity market over the next 3 months is extremely difficult. Extremely difficult. Nobody knows what the US stock market will be 3 months' time. I don't know, and I doubt if anybody can predict it accurately. However, if you do have a very strong view that the US equity market is going to fall over the next 3 months or the next 6 months, then it's natural to want to have less exposure to equities. And to be honest, if the US equity market falls, then Europe will fall as well. Asian stock markets will probably fall as well. So global equity is likely to fall. The US market is 60% of the global equity market. So if the US equity market falls, probably other countries would fall too. If you really believe that the US market is going to fall, then you'd probably want a lower exposure, in particular to this kind of growth portfolio. But as I say, it is extremely difficult to time markets like that. And so my advice to somebody thinking about that is don't try to time the market. Take a long-term view. The long-term return to global equities is positive and strong. And so my advice would be not to do anything drastic because it's so difficult to time something like the US equity market.
Sure, thanks for that. So I think that answer, will segue nicely to this question from another client, another participant. What's MYTHEO advice on investment portfolio on a mid to long-term objective?
Yes. So our approach to investing is very much a long-term approach. It's very difficult to predict what the returns of any asset are going to be over the next 6 months, over the next 12 months. Very difficult indeed. And so our advice always is to keep a diversified portfolio. All of the portfolios that we run, the growth portfolio, the income portfolio, the inflation hedge portfolio, they all invest across a wide range of different assets. So different asset classes, different countries, different markets. And the idea here is to diversify as broadly as you can to ensure that no single event really hurts you too much. By diversifying, you make sure that you get, in the long run, good, solid returns, but without big drawdowns in the value of your assets. So MYTHEO's approach, and I think it's a very sound approach, is to take a long-term view, diversify, and keep your risk under as much control as you can.
Sure. So well, we definitely have to stay diversified to manage our risk. And if you can manage your downside risk, I think upside return will come by itself over time.
Yes.
And okay, and there's this interesting question. How do you expect the increased interest rate to impact other portfolio like growth portfolio? And how do you expect ringgit to perform against US dollar in the next 1 to 2 years?
Thank you. Yeah. And that's a very good question. Yes. So underlying a lot of this is this expectation of rising interest rates, first in the US, but then perhaps later also in other countries, perhaps a little later in the Eurozone in Europe, but certainly a shift towards higher interest rates globally. And naturally, that's very bad for bonds normally, and so bonds provide a fixed interest rate, and so if interest rates are rising, then normally that's a negative thing for bond holders. Having said that, there's a range of different bonds. It's normally negative for kind of government bonds, things like that, low risk bonds. But higher interest rates can be positive for corporate bonds, maybe higher risk bonds as well, if that means that it's accompanied by a strong economic environment. Interest rate rising, can also be negative for equities. Having said that, if we think earlier about the signaling that we've had from the Federal Reserve, perhaps if we go back a few slides to here, the Federal Reserve have been very clear about signaling these increases in interest rates. And to an extent, these are already priced in to asset prices. This is all public information. Everybody knows what the Fed is saying. And so both the Fed and other economists are predicting these kind of increases in interest rates. And so if interest rates rise the way they're planned on here, it shouldn't be a big surprise to anybody.
Yep.
And so I wouldn't expect a huge market reaction if the Fed does go ahead and raise interest rates from the middle of this year, because they've been saying they're going to do that. Everybody knows it's coming. What would cause a problem is if the Fed starts to raise rates much faster than they've been predicting. Then you could see quite a large market movement, both in equities and in fixed income. What could trigger them to do that? Well, another spike in inflation could trigger them to move faster than this. As we looked at a bit earlier, this spike in US inflation is very specific to energy prices, and it's very specific to the supply-demand imbalance in oil prices. I expect that supply-demand imbalance to gradually even itself out. But if, for example, oil prices did go even higher from here, go towards like $150 a barrel, $200 a barrel, then that could trigger the Fed to raise rates even earlier. Then you could see some major movement in terms of equity prices and fixed income prices. But having said that, that's not what we expect. We don't expect something like that. And certainly someone like the IMF, most economists don't expect that to happen.
Sure. So, okay, question on rebalance. Does MYTHEO rebalance portfolio and how often?
Sure. That's a good question. So one of the benefits of MYTHEO is that it's all automatic. You choose the asset allocation that you want. You choose how much money you want to invest into it. And then MYTHEO will automatically keep you at that allocation. Our normal rebalance cycle is to rebalance you once a month. Markets move gradually, and different markets move at different rates. And so once a month, we will reset all of our clients back to their target allocation. Normally, those rebalances are quite small. It's not a sort of a high turnover kind of strategy. We're not churning your investments or anything like that. But normally once a month, we'll go and reset you back to your long-term target portfolio.
Sure. So thanks for that. Very interesting question here. I'm still a young guy and I'm willing to take a risk of loss for now. For a long term, let's say 5 to 15 years kind of investment horizon, between growth, inflation, hedge, which portfolio has the best chances of a larger return?
That's a very good question, yes. So maybe if we go down to here. So out of these three portfolios, if you think about their long run expected return, then the growth portfolio has the highest long run expected return. And then the second one would be the inflation hedge portfolio. And the third one would be the income portfolio. But having said that, naturally, the risk of the growth portfolio is higher than the risk of the inflation hedge or the income portfolio. So, and that's very natural in investing. If you're looking for higher expected returns, you're almost certainly going to have to deal with having higher risk. But as the question says, if you're relatively young and you have if you're lucky enough to have like a long investment horizon, then you probably want a relatively large allocation to the growth portfolio. And MYTHEO will automatically do that for you. One of the questions here, naturally, the first question is how old you are. And naturally, the younger you are here, the larger your allocation will be to the growth portfolio. And that's perfectly natural. If you've got a long horizon in front of you, you can afford to take some risk. You can afford to see out any downturns during there and look for that kind of long-term capital growth.
Sure.
The only other thing I'd just say there is it's easy to say that you can accept risk. It's easy to say that, but it's actually very difficult to live through risk. I've been investing for 25 years, and I've lived through, for example, the great financial crisis in 2008, 2009, and that was very, very scary. That was very, very scary to actually go through it day by day. You see the market in the US in particular falling 5-10% day after day after day. Global equity markets fell in half during the GFC, the Great Financial Crisis. And it's easy in retrospect to look at that graph and see that the price comes back. But at the time, it's very, very difficult to see that and stay put and not succumb to the kind of panic and pull all your assets out. What I would say is, it's very easy to say that you will accept risk, but you should also be aware that it's actually very difficult to live through it and watch, the value of your assets go up and down day by day. And in that case, something like MYTHEO that's automatically going to keep you balanced and diversified is probably a better approach than trying to do it yourself.
Yep. Yeah. So a question on the diversity, right? You mentioned the portfolio are very diversified, right? So would it be prudent to invest through MYTHEO solely, apart from other investment like in real estate, just solely investing in MYTHEO alone?
That's a very good question. Yeah, that's a very good question. I would say MYTHEO is designed to be a diversified portfolio. So from our point of view, just investing in MYTHEO would give you a very diversified portfolio. Having said that, and obviously we would prefer you to put as much as possible into MYTHEO. But having said that, as an individual, it's natural to want to diversify not just within your portfolio, but also diversify across different managers as well. And so my experience is that often we have clients who invest into MYTHEO, but also invest part of their assets into some other investment advisor, or as you said, maybe invest directly into real estate or something like that. I think that's a perfectly valid way of investing, yes. The only thing I'd say, just investing directly into real estate is obviously that's a very illiquid asset. You can't get your cash back out of physical real estate quickly at all. Real estate is included in the MYTHEO portfolios, but they're all in liquid form, so it's very easy to get your cash. So maybe you just want to be aware of this need for liquidity when you're also considering where you're going to invest.
Sure. Perhaps, there's this question, if you can share, what is the difference between MYTHEO versus unit trust?
Oh, sure. Yeah. So in one way, they're very similar. They're both offering diversified portfolios to individual investors. The biggest difference between unit trusts and MYTHEO is that with a unit trust, everybody who buys that unit trust gets the same portfolio. There's only one portfolio for that unit trust. So anybody who invests into it gets exactly the same portfolio. So there's no way to customize that unit trust to the needs of the individual. But robo-advisor services like MYTHEO, because we ask these kind of questions and because we structure our product in this way, we're able to tailor each portfolio to match the needs of each individual. And so that element of tailoring, of customizing the portfolio to match the needs of each individual, that's the biggest difference. You can't do that with a unit trust.
I see. Well, great. And thank you. I think maybe, do we have any more time? Okay. So I think there are still some questions left, but then I think because of the limited time, so we will get back to you on those unanswered questions. And thank you, Matthew, for an excellent discussion on where we should put money in today's environment with this concern about futures inflation. For me, the key takeaway of the discussion today are inflation, although could moderate from the current high, but should remain elevated, in the next 12 months. I think a lot of audience have also mentioned the same. And however, more importantly, I think perhaps for investors is that they can manage this risk to allocation to inflation hedge assets. And MYTHEO inflation hedge portfolio can be a useful portfolio diversifier for investor. And on behalf of us from MYTHEO, thank you very much for your participation. Thank you, everyone. And I will share a last video if everyone would like to look at how to invest with MYTHEO. You can actually refer to this video to guide you. Thank you.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.